And today I'm joined by Alasdair Macleod, who's a former stockbroker, banker, financier, and currently runs his own Substack, Alasdair Macleod Substack. Oh, but before we go into it, do remember to like and share and comment and all of that. I will be telling you that through this podcast, so we have to keep doing that. But the important part is Alasdair Macleod. Alasdair, good to meet you.
It's nice to see you again, Jasmine.
Thank you, Alasdair. Now, the reason I asked you to come along and be on this podcast, apart from the fact that I know you're good value, because you and I have spoken at the same events, is that I saw an article that you wrote about the fact that you feel that we are currently in the same kind of state as we were in 1929. So can you explain what you mean by that?
Yes, of course. I think the first thing to understand is where we are in the credit cycle. Credit expands and contracts. And when it's contracting, it's not good news at all. Because the other side of credit, of course, is debt. For every credit, there is a debt. Whether you're talking about a currency or whether you're talking about a bank deposit, anything. I mean, credit basically is the other side of debt. Now, people who don't understand that we might be in a credit bubble, I just ask them to look at the debt side. Are we in a debt bubble? I mean, undoubtedly, the answer is yes. We've seen this, and it's got to the point where governments are actually having difficulty funding themselves. I mean, you just look at the yield curve out along, into sort of, if you like, distant maturities, and governments can hardly fund anything out, say, sort of 20, 30 years. They're having to increasingly fund short term because that's the only place really where they can get any demand for their debt. You've got zombie businesses, which are loaded with debt. And they became loaded with debt basically because the Fed and other central banks suppressed interest rates ahead of COVID. I mean, it was really following the Lehman crisis, what they call the Great Financial Crisis. I don't call it that because I think there's something worse coming along. So credit has expanded because of the suppression of interest rates. And of course, it's the other side of debt. We can see that. Now, let's go back to a previous cycle. If we look at the 1920s, we know the Roaring Twenties. We had the Roaring Twenties. We read anecdotal reports about shoeshine boys giving you stock tips and all the rest of it. I mean, this is particularly from about 1926 through to 1929. Now we know what happened because Wall Street peaked in September 1929. There was a very, very nasty shock in October when the market really fell out of bed. But then it recovered. It recovered until around about May 1930. But then the bear market really hit. And what happened was it just went down and down and down. The Dow lost about 90% of its value. 9,000 banks went bust. I mean, extraordinary figure. So, I mean, that was the way in which, if you like, credit was being removed from the system. Not only was its value in the stocks going down, but also because banks were defaulting left, right, and centre, that was wiping out credit because the other side of credit was the debt, if you like, that a bank might owe you as a depositor. And it goes bust, whistle, you're in the wind, forget it. So that was the 1929 to 1932 experience because the market bottomed in 1932. And the problem with credit bubbles is nobody realizes that we're in a credit bubble. They're investing. They go out and they buy the stocks which are got momentum under them, the Nvidias of this world and all the rest of it. And I would say that one of the clearest indicators, if you like, of the excesses of this credit bubble is Bitcoin. I mean, what is Bitcoin? It's a concept. It's interesting because it correlates in its behavior with the NASDAQ and particularly with the Magnificent Seven stocks in NASDAQ. In other words, when they go up, Bitcoin goes up. When they go down, Bitcoin goes down.
That's a very good point. They do, yes.
the correlation actually, Jasmine, is quite tight. Now, that's because it's the same cohort of investors chasing the thing. They're chasing it like a NASDAQ stock, like a super tech stock. But what is it? It's like a tech stock without any assets in it, without any business, no earnings, just a concept. And when tech stocks go down, which they will, I mean, we remember what happened to NASDAQ as recently as 2009-10. What's going to happen to Bitcoin? I mean, that's going to create most enormous losses. Forget the idea of, this is a way to get out of fiat currencies and all the rest of it. And, there's hard stop of 21 million Bitcoin, whereas the Fed's printing is infinite. This is the Bank of England and all the rest of it. I mean, lovely concept. I don't disagree with the concept. But the idea that this actually protects you from the collapse of credit, no, because, it's not credit, but it doesn't have the legal status of money, and it never will be.
Why will it never have the legal status of money? Because it does. It's sort of in itself, in its own ecosystem. Can that not work for a lot of people to use instead of fiat money?
You can't ignore the legal status of money. It does not have that status. This is desperately important. I mean, Bitcoiners or hodlers or whatever they like to call themselves, are sort of keen to say this is something which shops will accept and all the rest of it. I mean, what a load of rubbish. They might accept it in certain parts of California, but as for the rest of us, it will be extremely unusual. Now, they are talking about this coming in as money to replace fiat. They are effectively anarchists. What they're saying is the whole system's going to fall apart and the only thing that's going to be there is Bitcoin. Well, how are you going to charge your phones if the whole thing falls apart? So how can you access your Bitcoin? It's a simple question.
I mean, when we're talking about fiat money, you're just talking about that huge number of banks that collapsed in the 30s or 1930. This could happen now. Then, if we are in the 1929 situation, then nobody should have money in banks. It sounds to me.
It works out differently this time. In those days, the Fed was new, and the banks that were going bust basically were not part of the Federal Reserve System. That's the important thing. There was, if you like, a motive for the Fed to get rid of any competition from, banks that didn't want to join into the Federal Reserve System. So that was actually a large part of it. There was also the politics of it because FDR, he just allowed banks to go bust in the very, very early days, which, that's a choice. Fine. No, it was all politics. This is all politics. Nowadays, it's very, very different. Of course, in those days, they were on a gold standard at $20.67 to the ounce, which eventually in January 1934 was devalued. The dollar was devalued by 40% to the $35 level, which most of us sort of, if you like, remember. Now, today it works differently. Why? Because every bank that goes bust has to be rescued. Why? Because the integrity of the system is of prime importance to every central bank and every regulator who are meant to be regulating these guys. So, if you see a bank getting into trouble, then it gets rescued one way or the other. I mean, it either gets rescued and sort of shoved into a bigger bank, or alternatively, somehow the Fed manages to print money to rescue it. Okay, so that's what happens. So this time, what we will see is not so much banks going bust, but the currency being debased as the whole thing gets rescued. There is another thing about this which I think is not widely understood. And that is that when credit risk increases, interest rates have to increase or bond yields also increase. The reason for this is that interest rates reflect the risk, if you like, inherent in credit. So we're in a situation now where just look at the UK. I mean, that's probably a pretty good example. We have got problems with the government. They can't cut their public spending. I mean, this is for the Labour Party to consider cutting welfare, I think is an indication of how serious the situation is. So we've got a problem. They've got to fund deficits. And those deficits are likely to be considerably larger than is publicly realised. I mean, we've seen high net worth individuals leave, taking their taxes with them. Bear in mind that the top 1% of earners pay 30% of the income tax. You've also got all the non-DOMs saying, we're out of here. And on top of that, virtually everything that Rachel Reeves did in her first budget has actually backfired on her. I mean, to give you an example, she reinstated the temporary suspension of stamp duty on house sales, whatever. Combination of factors, what happens? The whole property market is now seized up. There are no buyers. I mean, I read this morning that, you can't sell a house in Knightsbridge. It's just impossible.
Yeah, it's true. Yeah.
So the whole thing, and that's just one example of where things went wrong. And on the spending side, she gave everybody lovely, in the government, the bureaucrats and all the rest of it, and railway workers and doctors and so on, huge great pay rises. I mean, a lot more than they would have got in the private sector. Now, you can argue that, it's only fair because they got to catch up with the private sector. I mean, come on. We're talking about finances. We're not talking about fairness. So come this autumn statement, we are going to discover just what an unholy mess the whole situation is in. What does that do to gilt yields? They got to rise. Who's going to buy gilts? I mean, the foreigners at the moment actually own something. I mean, I can't remember the figure, but it's substantial. It's well over £1 trillion pounds worth of gilts. Are they going to sell them?
Well, that's a very good point. They could sell them. And if they do, is that going to mean that the Bank of England is going to print more? They're going to buy them themselves because nobody else will.
Well, if they do that, they'll undermine the value of the currency. So, here we are. I mean, the only reason I think why sterling hasn't started falling heavily is because at the moment the dollar's falling heavily. And of course, we're all sort of trying to get out of the dollar. So we buy anything, You can see.
Sorry, carry on.
Yeah, so you can see just how, the relationship between interest rates and the currency is so important. And to think that interest rates are a means of managing economic outcomes actually is a huge, huge mistake. The purpose of interest rates is to manage currency relationships. Every central bank in the West is getting this one horribly wrong. But having said that, I think central banks are beginning to realize the consequences of getting things horribly wrong, which is why they're adding to their gold holdings. What they are actually doing is not so much buying gold, but they're selling down fiat currencies in their reserves. They understand this. But of course, they can't tell us this.
So when you say they've got it horribly wrong, do you mean by bringing down interest rates and making it a lot cheaper? Has that been how they've got it wrong?
Well, there is yes. I mean, that's basically it. There is a tendency to try and suppress interest rates. Of course, every borrower wants to suppress interest rates. I mean, what has President Trump been saying? That guy at the Fed, Jay Powell, he should be sacked. He should be reducing interest rates. Look, Trump is a property developer and he likes low interest rates. He also wants the dollar down, because it's good for profits. He's actually looking at it purely from that sort of, I'm a businessman. I'm perfectly prepared to rob the depositors so that I get more money. This is actually what he is saying. But the idea that you can manage outcomes by manipulating interest rates is extremely limited, and it always backfires on you.
And you have been saying that we should get out of credit. So you're talking gilts. I assume you're talking corporate bonds.
Yep.
cash deposits in banks, all of that needs to go. And it has to be replaced with what? With gold?
Well, that basically is the only thing that doesn't have counterparty risk. Physical gold. I mean, ETFs have got counterparty risk because all you've got, and this is true actually of all equities, they're also credit, because the other side of credit is an obligation to pay it. It's slightly different from straight, debt on one side, credit on another. But a corporate stock or share basically is a promise from a company to pay you a stream of dividends or to accumulate value for your account as a shareholder. It's a promise. It's a promise to deliver something in the future, which is less defined than, say, a bond. So there is greater risk. Now, if the value of credit goes, then how are they going to manage to meet that commitment? If you're looking at a mining stock, that's possible. Because a mine, let's just say mining particularly gold or silver or copper, there's always going to be demand for that. And so the mine under those circumstances can deliver even through a credit collapse. And the important thing to understand is that we've got two worlds here. We've got the Western world, which basically is, Europe, America, North America, Japan, perhaps, Australia as well, who I was talking to this morning. We're all in one boat, that is for sure. But then you have got Russia and China in partnership, running the Shanghai Cooperation Organization and BRICS, which represents more than half the world's population, and on a purchasing power parity basis is probably pretty close to 50% of global GDP. This is enormous. And there are countries queuing to join BRICS in particular. So, I mean, this is actually something that Trump is trying to attack with excess tariffs. You want to join BRICS, we're going to tariff you another 10%. So, but it is an alternative world. And the great thing is that, I mean, if we do collapse, as we are bound to do if we continue on the course that we are on, then there is another half of the world which is going to carry on. Now, they will be badly affected by our collapse, but they won't collapse. They won't collapse with it. And the key to that is that China has already protected itself with hidden gold reserves, so it can put the yuan onto a gold standard like that. Now, she's not going to do it before it's absolutely necessary, and she will do it to protect her own currency from a collapse in the dollar. That is the key thing. The point about China is she doesn't make the mistakes. She lets other people make the mistakes. That's, every time I see President Xi at some sort of gathering, I see this little smile on his face. Inscrutable. I'm not doing anything. You make the mistakes. We're seeing that sort of thing all the time. And Putin, I mean, honestly, we decide to sanction Putin. We decide to confiscate or immobilize his currency reserves. And what does it do? It tells everybody outside the Western world, that basically we weaponize our currencies. So, why should we hold your currencies if you're going to use them against us?
Absolutely.
Yeah.
So, Alasdair, when it comes to the individual investor, shouldn't they still go for growth? Isn't growth important in order to overcome inflation? Shouldn't they continue to put money into stocks and shares as well as gold and silver?
Well, the problem is that if we were at the bottom of a credit cycle, I think that argument might have some merit. But we are at the top of the most enormous credit cycle, evidenced, if you like, by the ridiculous bullishness over something called Bitcoin, which actually is just a vol au vent. It's not even a tulip bulb which you could eat in desperation. This is tulipomania without any tulips in it. we've got the evidence, if you like, of the biggest credit bubble in history. Do you really want to buy something at the top of that? I would suggest that you would be very foolish to do so. No, it's now about preserving wealth, not trying to accumulate more wealth, because you will go down with the whole system if you ignore the risks to credit. And I mean, in terms of timing, obviously this is always very, very difficult. But I think if you see the US 10-year Treasury yield moving up towards 5%, you know the game is over, because already the relationship between bond yields, and particularly the long bond yield, and the returns, if you like, or the level of the S&P 500, that has got so stretched. It is more stretched than it ever has been in history, almost twice as stretched as it was at the time of the dot-com bubble. So this is something which, of course, no broker will tell you this because his business is to sell you stock. Every investment manager is in the same position. I've got to come up with a positive story in order to attract clients. I'm a better manager of equities than Charlie here, sort of thing. I mean, to turn around and tell people to sell the stock or just get the hell out of risk and all the rest of it, it's virtually impossible for anyone in the profession.
But that's what you're saying, is basically to sell your stocks.
What I'm saying is, now hold on, I'm not giving investment advice, but what I'm saying is there is huge risk here. Please be aware of it. And please be aware of why it is that gold appears to be rising so rapidly. It's not so much a question of gold going up. It's more a question of credit going down. Credit, particularly at the currency level. That's really what is going on. And that is really why the East is so keen on buying gold. It's not buying gold. It's just getting out of dollars and euros, if you like.
So essentially what your message is, and you're right, we are not giving financial advice, and it's really important to know that for all of our podcasts. None of them are giving financial advice. But your warning is that we're at a stage, you believe, where one should be protecting what one has with, I'm assuming, physical assets, gold, silver, commodities, maybe property even, although, as you said, that's sluggish, these kind of things, rather than credit-based products, shares, gilts, certainly cash in the bank, not a great idea.
The whole point about this is that, gold, silver, copper, as metals, but particularly gold nowadays, represents final settlement of all credit. So what happens when credit's value is called into question? Well, obviously it's reflected in the relationship between credit and gold. And that's what we're seeing now.
Your final word for investors right now would be what, from your perspective?
Please realize the risks. We are at the top of a credit bubble. We have Smoot-Hawley Tariff Act Mark II, courtesy of Donald Trump. This is just it's just a doppelganger for 1929 to 1932, in my view. Now, we're seeing the consequences of economic policy, the accumulated consequences of economic policy being reflected in the price of gold, which is no more than an exchange rate between two things: real money, which is final settlement of everything, and credit, which is yet to be settled. And that credit includes currencies. I mean, I've got economists who said, oh, no, currency, the dollar is money. No, it's a liability on the Fed's balance sheet. It is credit because there's a debt on the other side of it. The debt is owed to you. And a bank deposit is a debt of the bank, which is owed to you. All a bank is a dealer in credit. That's all it does. So, that's, and banks, I think, in declining or increasing risk in credit, they're going to require higher margins in order to protect themselves. Interest rates are going to go up. I mean, everybody believes that interest rates are going to go down. Forget it. I mean, they may have to reduce the interest rates on the front end of the yield curve, by a little bit because of, I don't know, because they'd promised to do it. But it doesn't make any sense whatsoever. But if they do that, all that will happen is they'll collapse the currency.
So protect your wealth, get out of credit,
Absolutely.
and that means cash as well as gilts and bonds.
Yeah.
And get into gold, get into the, as you say, the real money.
Yeah.
Like, wasn't it JP Morgan who said everything is credit, gold is the only real money?
Yeah, he was absolutely right. And he was actually stating a legal fact. Very unfashionable. Very unfashionable. I mean, obviously, you can't get totally out of credit because, you can't go down to the shop and say, give me a change for a sovereign or something. But actually, that is a very good point. Just to point out, a sovereign was originally issued by the, or if you like, issued by the Bank of England from about 1820 onwards, all the way to the First World War. And then again from 1925 to 1932, equal to £1 of its notes. A £1 note was a sovereign. Today, you need 600 of those pound notes to buy a sovereign. That is what's happened to credit. And has anybody noticed? No. Nobody's noticed.
Just a few of our viewers and our readers, they have noticed, and I've noticed, and I'm so glad that you came on, Alasdair. Thank you very much indeed for that. Alasdair Macleod, who's a former stockbroker and financier and banker, and currently has his own Substack, Alasdair Macleod Substack. It's very, very popular. Do have a look at that. This has been the Money Magpie Invest podcast. As I said at the beginning, like, share, comment. We're always interested in your comments and we always read them and answer them. And tell all your friends because you know you want to. And remember that nothing that's been said in this podcast should be taken as financial advice. You need to speak to a financial advisor if you need that. So see you next week. I'm looking forward to it.